everybody, and welcome back to the Deep Dive. Today, we're tackling a topic that's kind of like the backbone of commercial real estate.
Oh, yeah.
Rent constants.
It's a big one.
You know, you hear it all the time, but what does it really mean? And how can we use it to make smart decisions? Whether you're a seasoned investor or just starting out, this Deep Dive's for you.
I think a lot of people could benefit from this one.
To guide us through this, we're looking at an article by Allies Commercial Realty. It's called Understanding CRE Development Utilizing a Rent Constant.
Okay.
They're a brokerage based in Indianapolis, and they really lay out the what and the why behind this metric. So our mission today is to figure out how these rent constants can help us all make better choices in the world of commercial real estate.
Absolutely. It's a powerful tool.
So let's dive in. I know we're all familiar with rent in general, but
Yeah.
what exactly are a rent constant? Why does it matter so much, especially when we're talking about build-to-suit projects?
Well, think of it this way, like a way to connect the cost of developing a property to the income it could bring in. Let's say you're a developer building a custom warehouse for a tenant.
Okay.
You've put millions into construction. Now you need to know how much rent to charge to make it all worthwhile.
Yeah, so the rent constant helps you figure out that initial rent based on what you spent building the whole thing.
Exactly. It's a percentage, and you get the annual rent just by multiplying the total development cost by that percentage.
Okay.
So say your development cost is $8 million and you settle on 8% rent constant.
8 million times.
You just multiply those two.
8%. So that's $640,000.
$640,000 in annual rent.
Yeah. Okay.
I'm following so far. But then the article starts talking about high and low rent constants.
Right.
And I'm guessing that's where things get a little more
nuanced.
interesting. Yeah.
It's tempting to think that higher is always better, right? Because more income.
More money, more problems or something like that.
Not always.
A high rent constant, like 10 to 15%, usually means you're looking for a quick return on your investment. But that also means more risk.
Makes sense, because what if the market takes a dip? Then you're stuck with a high rent that's suddenly really hard to keep up with.
That's right. Tenants might struggle, or you might have trouble finding new ones who are willing to pay that much if somebody moves out.
Right.
The article uses the retail shopping center as an example. If you build one for $500,000 with a 15% rent constant, you're looking at $75,000 a year in rent.
Sounds great.
Sounds good on paper.
Yeah.
What if people stop coming? Or a big anchor store decides to leave?
Oh.
Suddenly that high rent becomes a problem.
I see. So does that mean a lower rent constant is always the safer way to go?
Not necessarily.
Okay.
A lower one, maybe 3 to 6%, might be more cautious.
Okay.
But it could also mean slower profits. You're relying more on the property going up in value over time instead of those big rental returns right away.
It's more of a long game. The article mentioned office buildings as an example of this.
Right. Imagine a $10 million office complex with a 4% rent constant.
Okay.
That's $400,000 in yearly rent, which might seem low compared to what you spent.
Yeah.
But you're betting on stability, attracting tenants with good rates, and maybe raising them later when the market improves.
Interesting. So it's not about just finding that one magic number for the rent constant.
It really depends.
It's all about knowing the trade-offs, how much risk you're okay with,
Absolutely.
and what you're ultimately trying to achieve with your investment. This is going way beyond just a simple calculation.
Oh, for sure.
I'm already seeing that.
It's much more than that.
Now, the article gave a helpful table showing typical rent constant ranges for different types of properties.
Yeah, that's a good visual.
I'm a visual learner for sure.
Me too.
What can we learn from that table?
Well, let's start with offices.
Okay.
They usually have moderate rent constants,
Okay.
influenced by lease terms, how reliable the tenants are, and operating costs. Then there's retail, which can be all over the place because location and foot traffic are so important.
Right. So a high-end boutique on a busy street is going to have a way different rent constant than like a discount store in a strip mall.
Exactly.
Yeah.
And then we've got industrial properties, things like warehouses and distribution centers.
Yeah.
Those usually have lower rent constants,
Okay.
simpler structures, long-term leases, and lower operating costs.
Lower operating costs means less risk for the landlord, so they can afford to be a little more flexible with the rent.
Exactly.
What about multifamily properties?
Those tend to have higher rent constants, things like apartment buildings.
Okay.
You're dealing with shorter leases, more tenant turnover, and trying to keep those units filled all the time.
It's fascinating how each property type has its own quirks that affect its rent constant.
Yeah.
Okay, we've got a good handle on the basics now, but how does this all connect to cash flow?
Right.
Does the rent constant actually tell us how much money a property is going to make?
That's the big question, and that's what we'll dig into in the next part of our deep dive. But just a little preview, while the rent constant itself doesn't paint the full picture,
Okay.
it's a vital piece of the puzzle, especially in those early stages of a project. It gives you a starting point for understanding your potential income and expenses.
Okay, awesome. So we've got
We've got more to cover.
more to cover.
Yeah.
We'll be back in just a minute.
Okay, so we've established that rent constants are more than just a number.
Right.
They're a starting point for understanding a property's potential for income.
Yeah.
But as you mentioned, there's more to it when we actually want to know how much money a property can really generate.
Exactly. You can't just assume that a high rent constant automatically means a profitable investment.
Okay.
There's more to uncover to truly understand the cash flow potential.
So walk me through it. Where do we even begin?
Well, the first thing, the most important thing, is to factor in those operating expenses we talked about.
Right.
Things like property taxes,
Yeah.
maintenance, insurance, even utilities.
All those costs can really vary.
Right.
Depends on the property type, the location, how old the building is.
And those expenses eat into your profit no matter what your rent constant is.
Exactly.
Yeah.
You could have a property with a really impressive rent constant, but end up with a lower net operating income
Okay.
than a property with a lower rent constant, but where you've got those expenses under control.
So it's not just about getting the highest rent possible, it's about finding that balance where your income is more than your expenses.
That's it. And that's where things like tenant quality and lease structures come in.
Yeah, you mentioned before that having a reliable tenant might be worth accepting a slightly lower rent constant.
Exactly, because a tenant with a good track record means less risk of late payments
Right.
or even defaulting, which can really hurt your cash flow.
Yeah.
On the other hand, even with a high rent constant, if you've got tenants who aren't reliable or lots of empty units,
Yeah.
that can be a financial drain.
It's like all these pieces have to fit together perfectly.
It is. It's a good analogy.
Yeah.
And like we said, rent constants are just one piece of that puzzle.
Right.
They give you some insight, but not the whole story.
Okay.
The article from Ally's Commercial Realty also pointed out some limitations of relying only on rent constants.
Yeah, we talked about how they can be a bit inflexible. They don't always adapt well if the market suddenly changes.
That's a big one. They're usually based on a snapshot of the market at a specific time, but real estate is always changing.
Oh, yeah.
Interest rates go up and down. Construction costs can jump unexpectedly.
Right.
Even zoning laws can change.
And all of that affects.
It all affects the property value and how much rent you can get.
So you could end up with a rent constant that's no longer realistic for the current market.
Exactly. And then you had to make some tough choices.
Yeah.
Do you stick with the original rent constant and risk being too expensive?
Yeah.
Or do you change your strategy?
Right.
Maybe lower the rent to attract tenants and keep those units filled.
It's a balancing act between sticking to your plan and being flexible when things change.
Absolutely.
The article also talked about considering the specific variations of each property when using rent constants.
Right.
Can you explain that a little more? I thought rent constants were supposed to provide some consistency.
They do, but even within the same type of property and location, there can be big differences.
Yeah.
Things like the age of the building,
Yeah.
the condition, what amenities it offers,
Okay.
even how close it is to transportation or other attractive features.
So two office buildings in the same neighborhood that seem similar on the surface could actually justify different rent constants.
Exactly. And that's why it's so important to do your research.
Yeah.
You can't just rely on a generic rent constant for that type of property.
Right.
You need to dig into the details of each individual property.
Get the full picture.
Yeah, to understand its value and income potential.
Okay, so no oversimplifying. Look at what makes each property unique.
Absolutely. And remember, the real estate market is always evolving. What worked in the past might not work today.
Right.
The article really emphasized this, talking about how sensitive rent constants are to market trends and the overall economy.
Well, yeah, it makes sense that when the economy is strong, rents go up.
Right.
When it's weak, they go down. But how does that actually play out with rent constants?
That's a great question. And that's where understanding how rent constants connect to other metrics like capitalization rates becomes really important.
The cap rates, yeah.
You got it.
I always get those mixed up with rent constants.
It's easy to do.
Can you give us a quick reminder of what the difference is?
Sure. A cap rate basically measures a property's rate of return.
Okay.
You calculate it by dividing the net operating income by the market value.
Okay.
Rent constants, on the other hand, are focused on the relationship between the development cost and the initial rent.
So cap rates are more about the overall return on investment,
Right.
and rent constants are about how those development costs translate into rental income.
Exactly. And here's how they connect. In a strong economy with low interest rates and high demand,
Yeah.
cap rates tend to compress,
Okay.
meaning investors will accept lower returns because they're confident about future appreciation and rental growth. This often leads to higher rent constants
Okay.
because developers are trying to maximize their income.
Makes sense.
But what happens when the economy slows down?
Yeah, what happens then?
When the economy slows, interest rates go up, or there's just too much available space.
Yeah.
Cap rates expand, meaning investors want higher returns to make up for the increased risk.
Okay.
And this puts pressure on rent constants to go down.
Right.
Developers have to be more competitive to attract tenants.
So it's like a seesaw.
It is.
When cap rates go down, rent constants go up and vice versa.
Exactly. That's why you need to understand the whole market when you're using rent constants.
Right.
They can be a helpful tool, but you have to look at them in the context of economic trends, interest rates, and what investors are feeling.
Okay. So much to think about. Wow, it's amazing how everything's connected. Rent constants and cap rates and the economy and even like how investors are feeling.
Yeah, real estate is a complex system for sure.
It really is. So for those of us who aren't, big-time real estate experts,
Right.
what are the key takeaways? How can we use this knowledge about rent constants to make better decisions?
I think the most important thing to remember is that rent constants are a tool, not a guarantee.
Right.
They can give you valuable information, but they don't predict the future.
So don't get fixated on that one number.
Exactly.
Yeah.
Don't let a good-looking rent constant make you miss the bigger picture.
Okay.
Always think about the specifics of the property, what's happening in the local market, and your own comfort level with risk.
Do your homework, basically.
Absolutely. And here's a practical tip. When you're looking at a potential investment,
Yeah.
don't just accept the rent constant they give you at face value.
Okay.
Do your own research.
What kind of research should we be doing?
Start by comparing the rent constant to similar properties in the same area.
Okay.
Is it in line with the market, or does it stand out? Remember, a high rent constant isn't always a good sign.
Right.
It could be a red flag, especially if the market's not doing so well.
So a little bit of healthy skepticism is always a good thing.
Exactly.
What else should we be looking for?
Look into the details behind that rent constant.
Okay.
What are the lease terms? Are any leases coming up for renewal?
Okay.
Are there any potential vacancies? Remember, tenant stability is key for steady cash flow.
Right, because even one or two empty units can really affect your profit.
Exactly. And don't forget those operating expenses.
Uh-huh.
How are they changing? Are property taxes going up? Is maintenance getting more expensive?
Yeah.
That attractive rent constant can lose its shine pretty quickly if expenses start eating into your profits.
It's like peeling back the layers.
It is.
Uncovering all the hidden things that can make or break a deal.
That's a great way to put it.
Yeah.
And that's where working with experienced professionals can be so helpful.
Okay.
People like the team at Allies Commercial Realty,
Yeah.
they have that local market knowledge, the expertise, and the negotiation skills to help you navigate all those complexities.
It's like having a guide in a confusing jungle.
Exactly. They can help you find opportunities, assess risks, and put together deals that work for you.
This has been an incredible deep dive.
It has.
We've gone way beyond just the surface of rent constants.
Yeah.
And really explored how a property's financials work.
It's all connected.
Any final thoughts for our listeners as they start their own real estate journeys?
My advice would be this. Knowledge is power, but taking action is key.
Right.
Don't let fear hold you back.
Yeah.
Educate yourself, find expert guidance, and take that first step towards your real estate goals.
Love it. Well, a huge thank you to our expert for breaking down rent constants and sharing your insights today.
My pleasure.
And to all of you listening, thank you for joining us on this deep dive.
Yeah, thanks for listening.
We hope you've learned something valuable that will help you in your real estate endeavors.
Absolutely.
Until next time, keep learning, keep exploring, and keep diving deep. Get in touch with Allies Commercial Realty at info@alliescommercialrealty.com to find your ally in commercial real estate.